Very good morning, my dear friends. So we are in the chapter amalgamation, and this session will be the final session for amalgamation. In fact, I want to discuss couple of problems based on the past examinations. So let's complete those problems as soon as possible within an hour. Then mid of the session itself, let's move on with the new chapter, that is internal reconstruction. That is the agenda for today's session. And before directly going with the current session, so in the last session I gave some HW, right? Hope you completed that. So related to accounting treatment in the books of limited and so balance sheet, I think so. In your notes, please explain what entry should be passed for that adjustment. Problem number 7, adjustment number 2. No, ma, this problem number 7 is related to a combination problem. Internal reconstruction and external reconstruction combinedly occurred. Okay. So with that intention, we not it dealt. So I ignored, right? I not yet discussed anything related to problem number 7. So once the internal reconstruction concepts will be over, then you can simply understand what the problem number 7 is all about. Okay. For the time being, you can ignore. Diksha. Okay. Just for your confirmation. Darshan. Oh, very big message. I went through some questions on amalgamation from revision test papers issued by ICAI. I'm having some doubts in it, sir. In one problem, the unrealized profit on stock is adjusted by deducting from reserves and surplus, sir. And another doubt, sir. In another problem, patents are not taken over. No, for related to the first one, sir, unrealized profit, the entry is so it is going to be adjusted under reserves and surplus only. Maybe that is the reason why they are directly reduced from the reserves and surplus. Ultimately, the other leg should need to be reduced from the stock only. Okay. Uh, I mean, if the capital reserve component is not clearly given, they might have reduced from the reserves and surplus. That is the reason, Darshan. And still the doubt is continuing. And another doubt, sir, in another problem, patents are, sir. Please explain. Sir, for this point, I'll tell you. Uh, 1 second, that's good doubt. Sometimes what happens, I'll tell you. Please concentrate. Sir, according to my procedure, what I told, if any particular asset is taken over by the purchasing company, you can make it transfer to realization. But if the particular asset is not taken over, you should need to separately open. Let us assume a particular asset so called as patents is not taken over by the purchasing company. If I open separately, let us assume the patent's value is 1 lakh. Now, if there is no value for the patents in the outside market, you are unable to sell such patents for any value, then the entire 1 lakh worth is loss only. Tell me, guys. Now, the entire loss, you should need to make it transfer to realization only. As per our concept, whatever the profit or loss derived through sale of patents in the outside market, we should need to make it transfer to realization only. Now, what is the net impact here? If I open the realization, in realization account, 2 patents only, 1 lakh. So just to simply follow blindly my procedure. That means if any particular asset is not taken over by the purchasing company, if it doesn't have any market value in the outside, then whether you are opening it separately or you can make it directly transferred to the realization account, both having the same impact. So to avoid the confusion, it is better to open separately and recognize the loss, then you can make it transfer to realization. That is one method. In another method, rather than doing all these things, you can simply directly transfer to realization account as well. That was transferred to the realization account, not with the reason of that particular asset is taken over by the purchasing company. That was transferred to the realization with a reason of loss arising due to such patents. Do you understand, Darshan? Hope it is clarified. Okay, fine. Uh, this point is a good point, and the same may happen in case of partnership accounts as well, guys. I don't know whether partnership accounts is completed or yet to be completed. In case of partnership accounts also, amalgamation of partnership firms is going to happen. Okay, sometimes uh, the particular asset may be sold by the amalgamated partnership firms. Then such thing they are going to adjust under realization account itself by passing the entry bank account data to realization itself. You can make it adjustment under realization account itself, or you can make it by opening separately. What I want to convey to you, don't be confused. For example, in case of partnership accounts, also same thing, the realization account we may open, because anyway it is also liquidation or closure of a particular entity. Okay, which is a dissolution of partnership firm. In that case, all the assets will be here, like plant and machinery, land and building, something will be here. These are having some book values like 50,000, okay, 2 lakhs something. Now, if you sell these assets, what is the journal entry you should need to pass? You should need to pass bank account data to realization account, because all these assets were already transferred to realization. That's why in realization, you can give by bank under credit side. Rather than doing like this, you can do in another way as well. Don't make it transfer this plant and machinery, land and building to realization. You can open separately. Plant and machinery, to balance brought down 50,000. For example, 2,50,000 total, right? Let us assume you sold for 3 lakhs. Then under realization, the 3 lakhs minus 2.5 lakh, 50,000 difference is coming as profit or loss in the first approach. But in the second approach, for example, in the plant and machinery, you sold for 75,000. Okay. Then buy bank. Then in plant and machinery, to realization, 25,000 will be the profit. Similarly, if you open the land and building, another 25,000 you will get as a profit. The concept is very simple. In the first approach, the total profit or loss is automatically derived under the realization account itself by comparison of book values and the real sale value. In the second approach, on the opening of individual assets, you may get the profit or loss on sale of individual assets basis. Ultimately, the profit or loss will goes to the realization account only. Are you sensing the difference, guys? Why I'm telling this point? If you want, you can directly make it transfer to realization, and automatically the profit or loss will be derived as a balance figure under realization account. Rather than you can open separately, the impact of profit or loss only you can make it transfer to the realization. This is what happening in case of partnership accounts as well. Sir, it's a little bit confusing. If you want to feel like that, then simply ignore whatever the approach I followed. If they taken, transfer to realization. If they're not taken, separately open. That's it. Okay. Yeah, picture unclear. I know why the picture is unclear. You should need to, picture is unclear means you are talking about my visibility or the content related. I'm talking about the partnership accounts. Unless otherwise you are having some knowledge on the partnership accounts. Now what I told, the picture will be unclear only. Okay. Fine. Let it be. Just I'm moving with my existing content, guys. But don't confuse. Just simply follow my 5-step approach blindly. You will get the answer. Okay. Now, guys, as I promise you, I'll take 2 problems related to past examination questions. Please, all of you come back to problem number 11. So to save my time, so today somewhat I'm going to discuss with my classroom PDF. Okay. I had already solutions with me. So if you already have, you can make it handy. Otherwise, simply follow my screen. Galaxy Limited and Glory Limited are 2 companies engaged in same business of chemicals. Okay. Their business is manufacturing of chemicals. To mitigate the competition, so one of the reason for amalgamation is to avoid the competition. So to mitigate the competition, a new company, Glorious Limited, is to be formed. So Glorious Limited is purchasing company Galaxy and Glory Limited both are selling companies. It is pure form of amalgamation. Is to be formed to which the assets and liabilities of the existing companies with a certain exception are to be transferred. So that means assets and liabilities of both the selling companies are transferred to the purchasing company, but some exceptions are there. We know such exceptions if we read the problem in full manner. The summarized balance sheet of Galaxy Limited and Glory Limited as of 31st March 2020 are as follows. If you observing since problem number 1 onwards, always they are providing the selling company's balance sheet only. Because to close the books of accounts, we require the selling company information in full-fledged manner. This question was asked in Jan 2021. Sir, how Jan 2021 is possible? I think that was Corona time. At that COVID situations, at that moment, November examinations were postponed to something like January. At that moment, they tested this question. Okay, fine. What is the balance sheet situation of both the companies? Let's have a look. Under shareholders fund share capital, equity shares of rupees 10 each were given. Under reserves and surplus, general reserve is there, profit and loss account given. Under non-current liabilities, secured loans 6% debentures were given. Under current liabilities, trade payable is there. Under assets, non-current assets, PPE, 3 assets are given: freehold property, plant and machinery, motor vehicles. These all are at net book value directly given. Current assets, inventory, trade receivable, cash at bank. Assets and liabilities are to be taken at book value with the following exceptions. Okay, the exceptions means, I think so all the assets and liabilities are taken over, but the assets and liabilities are not taken over at book value. The assets and liabilities are taken over at agreed value. This fact itself clearly indicates that the amalgamation is in the nature of purchase. Amalgamation in the nature of purchase. Because the assets and liabilities are not taken over at book values. The debentures of Glory Limited are to be discharged by the issue of 8% debentures of Glorious Limited at a premium of 10%. If you check, there are 2 sentences. This is the first sentence. This is the second sentence. The debentures of Glory Limited are to be discharged by the issue of 8% debentures of Glorious Limited at a premium of 10%. Discharged at face value, issued with premium. First, discharge is only important for me. Sir, discharged with par means, if you check in the Glory Limited debentures, 3,30,000 is there. For 3,30,000 worth of debentures, how much worth of debentures I am going to issue? Same, discharged with par means 3,30,000 worth only I am issuing. But each and every debenture I am issuing with premium. That means at the rate of 110. So 3,30,000 divided by 110 means, I know 3,000 debentures, right? Tell me, guys. So 3,000 debentures. That means in the books of the purchasing company, the agreed value of the debentures will be 3,30,000. After acquisition, we should need to cancel the Glory Limited debentures. We should need to issue our own debentures. We should need to credit the debentures capital 3 lakhs. 30,000 we should need to treat it as. We should need to treat securities premium. That is the meaning of the sentence for point number 1. That is the adjustment we should need to make at the time of amalgamation. Okay. Next, plant and machinery of Galaxy Limited are to be valued at 2,52,000, which is agreed value of plant and machinery. Goodwill is to be valued at, for Galaxy 4,48,000, for Glory 1,68,000. Okay. Liquidator of Glory Limited is appointed for collection from trade debtors and payment to trade creditors. He retained the cash balance and collected 1,10,000 from debtors and paid 1,80,000 to trade creditors. Liquidator is entitled to receive 5% commission for collection and 2.5% for payments. The balance cash will be taken over by the new company. Sir, what is this point number 4, sir? All are normal points only except point number 4. This is the first time you are encountering. But how they are providing the information, similar way, I should need to simply provide the adjustment. That's it. Nothing is great. Now, both the selling companies, they may appoint their liquidators, right? Out of which he is talking about liquidator of Glory Limited is appointed for collection from the trade debtors. Okay. And the payments to trade creditors. He retained the cash. He retained the cash means, first if I check the Glory Limited. So this is about Glory Limited. Glory Limited cash balance, how much exists? 1,04,000. First, this 1,04,000 taken over by the liquidator of Glory Limited. Okay, I started with 1,04,000 and collected 1,10,000 from the trade debtors. After that, he collected 1,10,000 from the trade debtors. Okay, and paid 1,80,000 to trade creditors. Then he paid 1,80,000 to trade payables or the trade creditors. Super. Now, after doing all such things, he will also reduce his commission. Liquidator is entitled to receive 5% commission for collection and 2.5% for payments. On collection, 1,10,000 into 5%. That is 5,500. On collection, his commission is 5,500. And on payments, his collection is 1,80,000 into 2.5%, which is 4,500. Now, how much cash available with the liquidator after doing all such things? 1,04,000 plus 1,10,000 minus 1,80,000 minus 5,500 minus 4,500. 24,000 worth of cash is available in the hands of the liquidator after collection from debtors, after settlement to trade payables, and after retaining cash, after deducting his commission. That is the point he mentioned. The balance cash will be taken over by the new company. This 24,000 only taken over by the new company. Sir, that means trade debtors, is it taken over by the purchasing company? No. Trade payables of Glory Limited, is it taken over by the purchasing company? No. Is it cash balance mentioned in the balance sheet taken over by the purchasing company? No. 24,000 is taken over by the purchasing company. That is the information indirectly he is conveying through point number 4. Now, let me read the further information or the requirement. Compute the number of shares to be issued to the shareholders of Galaxy and Glory Limited, assuming the face value of each share in the Glorious Limited is 10 rupees. Prepare balance sheet of Glorious Limited as on 1st April 2020 and also prepare notes to the accounts as per Schedule 3 of the Companies Act 2013. Maybe the problem may ask for the 15 marks. The compute the number of shares to be issued means indirectly he is asking computation of PC only. Rather than asking in terms of rupees, that is amount, he is asking in terms of number of shares. That's it. Now, first of all, let me know what is the method of PC. Please, all of you participate. What is the method of PC? Oh, no one is telling the answers here. What is the method of PC? Oh, sorry, Sahu. I thought of earlier you may not understand my content. My picture is unclear. Okay, got it. No issues. Yeah. So method of PC is net asset value method. So finally all the members gave the correct answers. That means now you are in the track. Now your people are in a situation to identify the method of PC particularly. That's great to hear. Fine. Now let me know if the method of PC is NAV method. I should need to know all the assets agreed values, all the liabilities agreed values. Okay. Just to save my time, I will calculate the PC from my written PDF. Let me consider for the discussion. So method of PC is NAV method. NAV method. Now one by one, let me know taken over or the agreed value for assets, first of all, freehold property. Under that, plant and machinery only having the different value, remaining all are same at book value. So that's why freehold property as it is book value 5 lakh 88, 3 lakh 36. Yes, if you check here, plant and machinery. So it is clearly given that for Galaxy Limited is it to be valued at 2 lakh 52,000. That's why Galaxy 2 lakh 52. For Glory, you can consider the as it is, which is 84,000. You can consider the as it is amount 84,000. Next, motor vehicles. So nothing was mentioned. That's why at book value only 56,000. Next, if you come down, inventories. Inventories, nothing was discussed. That's why as it is book value 336, 438. Next, trade receivables. Only purchasing company is taken over for Galaxy. Sir, for Glory, purchasing company will not taken over anything. Why? Liquidator is going to collect. Liquidator of Glory Limited is going to collect. That's why purchasing company will not collect, or purchasing company will not taken over this trade receivables. That's why only you can consider for Galaxy 4 lakh 62. For Glory, it is nil. This is the important point. Next, cash at bank. So this is 2 lakh 38,000 as it is, but this is not 1 lakh 4,000. We found just right now, this is 24,000. For Galaxy as it is book value, but for Glory 24,000. So here if you check, 2 lakh 38 for Galaxy, but for Glory 24,000. You should need to clearly provide the working note. Whatever the thing I done on the problem side, I clearly provided as a working note 24,000 how they got. That is existing cash balance 1 lakh 4,000, collections from debtors 1 lakh 10,000, payment made to trade payable 1 lakh 80, and their commission I reduced. Then 24,000, whatever the cash balance lying with the liquidator, the same cash balance is taken over by the purchasing company. This is all about assets, guys. If you start with the liabilities side, so liabilities 6% debentures. Sir, discharged at par means at the same book value. Agreed value of the debentures is 3 lakh 30,000 only. That is in Glorious Limited, and a trade payable 4 lakh 20 only you should need to consider for Galaxy. Don't consider for Glory. Why? For Glory, who is paying the, or who is settling the trade payables? Liquidator. That's why this trade payable is not taken over by purchasing company. So 420 only you can consider here nil. Now NAV I am getting 19 lakh 60 for Galaxy, 7 lakh 20,000 for Glory. Now it is clearly given the issue price is at the rate of 10 rupees. Then you should need to calculate number of shares issued as PC. If you divide with 10, then you will get number of shares issued as PC. That's why always number of shares issued as PC is equal to amount of PC divided by issue price. Here issue price is nothing but par value that given. Okay. Next, prepare balance sheet of Glorious Limited as on 1st April 2020 and also prepare notes to the accounts as per Schedule 3 of the Companies Act 2013. Again, I am providing this as HW, guys, because nothing is new, but just if you want, I'll try to correlate with my printed solution. Okay. So just if I start with the balance sheet, so share capital, how I should need to work. How many number of shares issued as PC? If you can add multiply with 10, which is nothing but the share capital. If you check here, you can just make it total 19 lakh 60 plus 7 lakh 20. How much you are getting? I'm getting 16 lakh 80,000. That will be the PC. That will be the share capital. And 1 second. For Glorious, anything is there? No, for Glorious, I mean, the existing balances are nil. That's why only you can add for Galaxy and Glory Limited. So 19 lakh 60,000 plus 7 lakh 20,000. It will be 26 lakh 80,000 worth of share capital I'm getting. So 26 lakh 80,000. If you check, 2 lakh 68,000 equity shares at the rate of 10 rupees each. Just I combined both the equity shares issued as PC. Then next, sir, PC is equal to NAV. That's why there is no chance of occurring any goodwill or capital reserve. That's why for capital reserve part, it will be nil. But debentures are issued with premium. That's why securities premium will be coming into the picture for 30,000. The same they put it. I already explained if you remember. Debentures, we are issuing at the rate of face value. So that's why 3000 debentures we are going to issue. 3000 multiplied with 100 will be the face value. 3000 multiplied with 10 will be the securities premium. The 30,000 will be the securities premium. Long-term borrowings, that is only debentures for 3 lakhs. Trade payable, so only we are considering for Galaxy. So remaining all assets, you need not worry. If you go here, if you add line by line addition, that will be the taken over value for all the assets. If you're not believing me, just you can add all the assets, only assets value. Simply, in simple manner, I will add. Please concentrate. I know the NAV, right? I am adding back these two components. Then I know the total of the assets. The total of the assets should need to be matched with the total of the assets of the balance sheet. Do you understand my logic? So let me do that. 19,60,000 plus 7,20,000. I'm getting 26,80,000 plus 4,20,000 plus 3,30,000. Now I got total of the assets 34,30,000. Just the backward calculation I made, nothing else. So let me check the balance sheet total of the assets 34,30,000. I got it right. So that's why no need to verify each and everything again, because at the time of computation of NAV, all the assets taken over, all the liabilities taken over, I consider the same values. If you can add line by line addition, then you will simply complete the asset side as well. That is all about 2020 examination problem, guys. So anything difficult here? Okay, one person is asking one doubt, not related to this question. Okay, sir, there are 1,18,000 debtors, but liquidator realize only 1,10,000. What about the difference of 8,000, sir? If difference of 8,000, I mean, it is due to loss you are asking, or there are two cases. Let me explain. For example, out of 1,18,000, 1,10,000 he can able to realize, remaining 8,000 he unable to realize. That is the first case, then which is loss. You should need to make a transfer to realization. That is not the case, sir. Liquidator only collected out of 1,18,000, 1,10,000. Remaining 8,000 debtors still exists, sir. Then you should need to check the remaining debtors. Is it taken over by the purchasing company, or the remaining 8,000, is it sold in the outside market? If it is taken over by the purchasing company, you should simply make it transfer to realization account. If the remaining 8,000 liquidator is going to sell in the outside market, then you should need to go for that particular thing. Okay. But that 8,000 will not still exist in the selling company, because selling company is going to close. That point you should need to understand. Okay. Yeah, fine. Can I go to one more examination problem? Are you with me, guys? All of you? Shall I go? Okay. Let me take one more exam problem. So problem was asked in July 2021. Okay. So what the question is all about? Let me read first. The summarized balance sheet of Black Limited and White Limited as on 31st March 2020 is as follows. So under equity and liabilities, shareholders fund, share capital is given. Guys, please observe all of your rupees are in thousands. Under share capital, if you check, only equity shares are there, rupees 100 rupees each. Amount is 60 lakhs, 36 lakhs. Next, reserves and surplus. Note number 2 exist. General reserve is there. Profit and loss account is there. Okay. Then current liabilities, trade payables is there. Next, under assets, non-current assets, PPE is there, property, plant and equipment, no further classification. Current assets, inventories exist, trade receivable, cash and cash equivalents. Black Limited takes over White Limited on 1st July 2020. Then Black Limited is purchasing company, White Limited is selling company. Now, please be attentive here. So the balance sheet information given in the problem as on 31st March 2020. But the Date of amalgamation is 1st July 2020. So this is the first time we are come acrossing amalgamation date is different from balance sheet date. Or else, if at all the balance sheet status, if they provided as on 1st July 2020, then we may directly go with amalgamation procedure. But the problem is, I should need to revamp the balance sheet. I should need to rework the balance sheet. What is the status of assets and liabilities as on 1st July 2020? For that reason only, I'm picking this problem. So that means this problem special point itself is, or this problem type itself is, balance sheet date given in problem is different from amalgamation date. If that is the case, what I should need to work out? I should need to rework the balance sheet as on date of amalgamation. Then I should need to start the amalgamation procedure. Amalgamation procedure, you know. So then how to revamp the financials for this particular date that is not related to any particular chapter? Sir, how much increase in assets or how much decrease in assets? In the similar way, how much increase or decrease in liabilities you should need to work out for these 3 months. Accordingly, you should need to make the adjustments. Then the worth of the balance sheet or the net worth, you can clearly know as on 1st July 2020. Once you fix the balance sheet as on 1st July 2020, then you should need to go with the amalgamation procedure. Okay, further let me read for better clarity. No balance sheet of White Limited is available as on that date. So selling company balance sheet is not available as on 1st July 2020. But it is, however, estimated that White Limited earned a profit of 2,40,000 after charging proportionate depreciation at the rate of 10% per annum on PPE during April to June 2020. Let me know 3 months depreciation first on the PPE. So on the PPE, 3 months depreciation 2,400, that is 24 lakhs. Rupees are in 1,000, right? So directly you can consider the same figures. We will also just let us put the rupees in 1,000. 2,400 into 10% into 3 by 12. How much depreciation on PPE? So I got 60. So after reduction of this depreciation, it is estimated that 3 months profit in White Limited leads to 240. If the rupees in thousands, which is 240. Okay. Next, estimated profit of Black Limited during these 3 months was 480 after charging proportionate depreciation at the rate of 10% per annum on PPE. Here also I should need to depreciate PPE at the rate of 10%. That is 3,600 into 10% into 3 by 12. So just, I don't know what he's really asking. Just what is the amount of depreciation I'm working? Okay, I'm not doing the problem. Just I'm reading the problem. So here I got the depreciation 90. So PPE, depreciation on PPE in white is 60, in black is 90. Both the companies have declared and paid 10% as dividend within this 3 months period. Okay. Declaration of dividend and payment of the dividend was also done. Goodwill of White Limited is valued at 2,40,000. Property, plant and equipments are valued at 1,20,000 above the depreciated book value on the date of takeover. Simply agreed value of some of the assets they are providing. Purchase consideration is to be satisfied by Black Limited by issuing shares at par. Ignore income tax. You are required to. Oh, total 4 requirements are there. What are the requirements? Compute number of shares to be issued by Black Limited to White Limited against the purchase consideration. Simply calculate the PC, divide with the issue price. You will get number of shares issued as a PC. Okay, so the point number 1 is PC. Point number 2, calculate the balance of net current asset of Black Limited and White Limited as on 1st July 2020. So they are asking, this problem is, point number 2 is not relevant for amalgamation. This is the general question. So net current asset status. Net current assets means current assets minus current liability status as on 1st July 2020 for both the companies they are asking. Give balance of profit and loss of Black Limited as on 1st July 2020. That means after amalgamation, P&L account balance, how much showing in the balance sheet for the Black Limited he is asking. Give balance of property, plant and equipment as on 1st July 2020 after takeover. Simply P&L, PPE. Method of PC. Sir, he is only providing purchase consideration is to be satisfied by Black Limited by issuing shares at par. The issued shares are at par. But how much I should need to issue? I don't know. Sir, how much worth I should need to issue if I don't know? Which method I should need to adopt? NAV method, guys. Sir, to adopt the NAV method, 1 second. Yeah. To adopt the NAV method, what I required? I required assets and liability status as on 1st July 2020 of White Limited. Then only I can work out the NAV. Do you know all the assets and liabilities of White Limited as on 1st July 2020? No, I should need to work on some assets. I know one thing. One by one, let us check the one by one assets and liabilities. Now, if you check property, plant and equipment, which is the first asset, it is clearly given that PPE, the value is 2,400, but 3 months depreciation is there. 2,400 minus depreciation for 3 months, how much? 60. Let me reduce the 60 depreciation. And it is clearly given that in point number 5, property, plant and equipment of White Limited are valued at 1,20,000 above the depreciated book value. This is the depreciated book value. Above this 1,20,000 added for the knowing agreed value. 1,20,000 means you can only consider 120 rupees in thousands. Then you know the PPE agreed value. PPE agreed value how much? PPE agreed value is 2,460. This is how you should need to value each and every individual asset as on 1st July 2020 for knowing the PC or for knowing the NAV. Next, sir, after PPE, what will be the next asset? Current assets, inventory. Sir, if nothing was mentioned means same book value, that is 720 only. Trade receivables, 1080. If nothing was given means the same book value with which they may consider. But you may ask one question. Sir, this inventory and trade receivable that is mentioning as on 31st March na, but how you can assume the same values will be there as on 1st July? There is no other option for me. How I can able to calculate these values if they are not providing in the problem? Then I can assume that, so for those assets and liabilities, no further information is provided in the problem. I can simply assume the same book values are going to continue as on 1st July also. Next, cash and cash equivalents. Sir, cash and cash equivalents I can able to calculate, guys. How you can able to calculate? So separately here, cash and cash equivalents you can put. Working note number 1, cash and cash equivalents. For both the companies you can calculate. For both the companies you can calculate. Why, sir? Sir, in the second problem, they are asking net current assets as well. At that time also, I required the cash and cash equivalents of black. So that's why what I'm doing, black, white. Existing cash, how much? Existing cash, 1440 here. 420 here. This is the existing cash. Then in these 3 months, related to cash, what happened? First point, no impact for cash. Second point, White Limited earned a profit of 2,40,000 after charging the depreciation. This 240 is after depreciation only. Then whatever the profit is there, you can simply assume that it was in the realized form of cash. Then 3 months profit. after depreciation only. If it is before providing depreciation, depreciation is a non-cash expense. Okay, then you should need to directly consider that. But after providing the depreciation, first you should need to give the profit. Then you should need to add back the depreciation as well, because depreciation is a non-cash expense. I required cash profit. After providing depreciation, this is the profit. But before providing the depreciation, I require the profit is how much? Because depreciation is a non-cash expense. It is also in the form of cash. So first you can add the profit after depreciation. This is 240. Sorry. Here it is 240. For black, it is 480. Then depreciation also given. Here it is 90. For white, it is 60. Do you understand all of these points? So depreciation I added. Profits also I added. Next, both the companies have declared and paid 10% dividend within this 3 months period. So dividend payout means cash balance will decrease. Let's work out the dividend. How much percentage? 10%. So here 10% means 6,000 into 10%. 600, right? Here 360. So dividend minus dividend 600, 360. Next, point number 4 up to done. 5, it doesn't impact the cash balance of the entity. Yeah, that's it. Remaining all our requirements. So you can calculate the closing cash balance as on 1st July 2020. 1440 plus 480 plus 90 minus 600. 1410. Here 420 plus 240 plus 60 minus 360. Here I am getting 360, which is the cash balance as on 1st July 2020. Now the same cash balance you can consider for White Limited. How much? They are getting 360, right? 360. Okay. My calculation is correct only, right? No clerical errors. Okay, that's fine. Sir, you considered all the assets under NAV, PPU over inventory, trade receivable, cash and cash equivalents. Let's start with the liabilities. Under liabilities part, current liabilities, only one liability is there, which is trade payable. It doesn't impact anything. So trade payable, you can consider directly 360. Now, NAV of Black Limited, how much? 2460 plus 720 plus 1080 plus 360 minus 360. 4260, I'm getting the NAV. Okay, let me verify the accuracy of the numbers with my PDF. Oh. So which is 2460? Everything was considered. Goodwill is also there, na? I forgot. One second. Here one point is there. Goodwill of White Limited is valued at 240, and property, plant and equipment, something he is telling. So goodwill is also taken over by the purchasing company. So you can add the goodwill also under the assets. I forgot actually. So which is 120. Okay. Now NAV will become how much? You can add 4260 plus 120, which is equal to 4380. Still, I think so it doesn't matching. Just give me 1 second. Let me check the accuracy of 1 by 1 figure. Then we know anything we ignored. Sir, PPE 2460 I considered. No, 2460. Yes, it's absolutely matching. Goodwill 240. Goodwill is 240, not 120. Yeah. 1 second. I'm so sorry, guys. Goodwill of White Limited is valued at 2,40,000 and property, plant and equipment are 120. Goodwill valuation is 240 only. I read correctly, but I gave the wrong figure. Just a moment. I'm so sorry. So 240. Now you can give the correct figure. Earlier I got 4260. If you remember, 4260 plus 240 I'm adding. So 4,500 NAV. Okay. Anyway, just I'm cross verifying the accuracy of the figures one by one. Inventory 720, trade receivables 1080, cash and cash equivalent 360 I got. I also got 360. Then liabilities trade payable 360, and NAV is 4,500 and NAV is 4,500. This is the answer for first sub question. But they not asked the PC. They asked how many number of shares issued as PC, right? Compute the number of shares issued by Black Limited to White Limited against the purchase consideration. It is clearly given that purchase consideration is to be satisfied by Black Limited by issuing shares at par. Sir, by issuing shares at par means Black Limited shares are at 100 rupees. If you issue the shares at par, then number of shares issued as PC is equal to 4,500 divided by 100, which is equal to 45. 45 means 45,000 because all are in thousands. So you can simply put it as 45. Okay, that is first sub question answer. Is it okay to all of you guys? Next, you can come to second sub question. Calculate the balance of net current assets of Black Limited and White Limited as on 1st July 2020. Sir, already White Limited, it is readily available. How, sir? Sir, White Limited, current assets, these three. Current liability, this one. If you add these three components, if you reduce this component, then you will get current assets of Black. Sir, what about current assets? Current assets of White. Sir, what about current assets of Black? Sir, there is no change in inventory with the book value. The same inventory you should need to consider for Black. Trade receivables, same you should need to consider. But cash and cash equivalent, you should not consider this figure. Which figure I should need to consider? Cash and cash equivalent, 1410. So here you should need to consider 1410. For trade payables also, you should need to consider the same figure. 960 plus 1680 plus 1410 minus 600, you will get net current assets of Black as well. So let me verify the same thing with the PDF. So cash balance for Black 1440. This is working out for cash, not this one. Yeah, this is the second point. Inventories for both the companies as per balance sheet. Trade receivable for both the companies as per balance sheet. Cash I already worked out as per the above working note, which is 1410 and 360. Trade payable as per the balance sheet. Then you can get simply the net current assets. No difficulty, guys. Once you are finalizing the cash balance, net current assets is dead easy. That is altogether point number 2. Now you can come to the third sub question. Give balance of profit and loss account of Black Limited as on 1st July 2020. Now all of you let me know first the existing Black Limited P&L how much? In balance sheet after amalgamation P&L shows how much he is asking. Now it is clearly given under notes to accounts for Black Limited existing P&L is 720 for Black. Do you agree? Plus how much profits we are getting from White Limited. Is it amalgamation in the nature of merger or amalgamation in the nature of purchase? Anything they mention? But we know definitely the items are not taken over at book value. That's why amalgamation is not amalgamation in the nature of merger. Definitely amalgamation in the nature of purchase. Then I am not eligible to consider the profit and loss account of White Limited. You can ignore that. Sir, this 720 profit is the profit as on 31st March. I should need to consider the Black Limited 3 months profit as well. I know Black Limited 3 months profit, which is 480. And Black Limited declared the dividend as well. Don't ignore that. At the time of declaration of the dividend, the entry is P&L accounted up to dividend payable, then dividend payable to bank. That's why you should need to decrease to the extent of dividend from the P&L as well. So dividend was how much? So dividend 10% of dividend means 360. Now if you work out 720 plus 480 minus 360, I got 840. So you can check here. Dividend is 600. Sorry, I wrongly worked for White. So sorry, 600. So how much it is? Please change the calculation. 720 plus 480 minus 600, which is equal to 600. So please cross verify here. Opening balance 720, 3 months profit after depreciation 480 minus dividend declared and paid 600. So this is the P&L account balance of Black Limited after amalgamation. Don't consider the P&L of White Limited because amalgamation is in the nature of purchase. How you know? It is clearly given that goodwill we are additionally considering, property, plant and equipment we are not taken over at book value, we are taken over at different value. That's why this is amalgamation is in the nature of purchase. Okay, one last sub question. Give balance of PPE as on 1st July 2020 after takeover. Okay, please consider it all of you. What is the existing PPE balance? In black first, 3,600. This is the existing PPE. From the existing PPE, it is clearly given that 3 months depreciation we are going to provide. So 3 months depreciation in Black Limited, how much? We already worked out. In Black Limited, 3 months depreciation is 90. So you can reduce that 90. Plus taken over or agreed value of PPE from White Limited. You should need to add in the balance sheet both. What is the agreed value of the PPE? Here it is there under NAV. It is clearly there. Agreed value of the PPE. Agreed value of the PPE is 2460. You can simply add the 2460. If you add this, then you know the closing balance of PPE. It should need to be shown in the balance sheet after amalgamation in the books of Black Limited. So that is 3,600 minus 90 plus 2460, which I am getting 5970. Okay, you can check 5970 with the accuracy of figures as well. Guys, the only one point here, the pain is you should need to do a lot of calculations. So what is the value as on 31st March? What is the value as on 1st July? You should need to every time work out, and you should need to provide the sub-question answers. That's it. Apart from that, nothing is great. Just let me know still if you are facing any issue or if you are having any doubt in this problem. Tell me, guys. Still I am waiting. One second. Darshan is asking one doubt. Darshan is always asking many doubts. Okay, what is this doubt? Let me know. Sir, in the previous problem, our assumption is that the liquidator realized whole debtors and the balance amount is bad debts, which will be transferred to realization account in the books of selling company, sir. Yeah, why not, ma? So what he's asking, I understand. So liquidator of Glory Limited is appointed for collection from trade debtors, right? How much he collected from trade debtors here? He is thinking the accounting treatment in the books of selling company. 1,10,000 he collected from debtors. If you check the debtors balance here is how much in Glory, right? Yeah, in Glory debtors balance is 1,18,000. Out of 1,18,000, only to the extent of 1,10,000 only collected. What about the remaining 8,000? Loss is unable to collect. Simply trade receivable. We will open separately. Trade receivable 1,18,000. So he can able to collect buy bank 1,10,000. Remaining 8,000. Why you are worrying about that? Just follow my approach. In step number 4, after receiving the PC, whatever the assets and liabilities which are not taken over by the purchasing company, realize in the outside market. At the time of realization of such assets and liabilities, if liquidator deriving any profit or loss, such profit or loss will automatically transfer to realization account only. Okay. You follow that 5-step approach, you may not deviate. Okay. Fine. Super. Guys, you know, amalgamation chapter is such a big ocean. It may not complete at any point of time because always the examiner is having the choice to include any type of adjustments. If you do 100 problems, there may be a chance to ask one at one type of problem. So that's why what I can suggest, rather than doing n number of problems, it's better to always have good clarity on the content or the concept and do some problems for the practice and apply the knowledge what you earned. If you are having good application mindset, whatever the problem they may ask in the examination, simply you can crack. But to know the flow, to understand how the adjustments are going to be given, further definitely you should need to make practice for some questions. Okay, just make habituate always the application mindset is going to be tested by the ICAI. This is the same case happened in case of CA final as well. In fact, there is no difference between CA inter and CA final, my point of view. So the same type of questions and the same type of knowledge they're expecting. The only one thing is where the people are going to fail, they always go with numbers. They always go with the similar models, similar type. That doesn't work out for professional courses, guys. Understanding the concept and grabbing the concept and application of such concept to various practical situation. If you know that well, if you can manage well, then you can qualify the examination in very simple manner. So that's where the gap is there. Students should need to feel that, and students should need to feel that. Not only in case of financial reporting, so in all the subjects, the same thing is going to applicable for including the theoretical papers. Okay. For example, if you can consider the audit exams, or maybe if you can consider the strategic management and information technology, or maybe economics, whatever the case may be, what are the papers you may have. Always you can think in that particular angle, crack in that particular angle, prepare in that particular angle. So you can simply provide answers for examinations. And one more thing, guys, sir, getting the concept and understanding of the problems is different story. Presenting the same in the examinations is also different ball game. So a lot of times the presentation issues may also coming into the picture. So please all of you make it present the answers in legible manner. No confusions, nothing. Okay. Don't give so much of priority on handwriting and spending much time on like beautiful presentation, looking like beautifulness, not required. So do you mean that we can write like anything? That's not my intention. You can give the legible answer. That is more than enough. You can give clear cut gunshot for me. That is more than enough. So spend your good time on the presentation of the main aspects. Okay. That's what my intention is. Hope you understand, because the paper is lengthy. You may not spend much time on a single problem. So whatever the time is allocated for that particular problem, you can just provide that time. If you are providing more than that time, means you are losing another problem. Please try to understand that point. Okay, guys, at this stage, let's go for a break. Please, all of you assemble exactly by 8:15. So today, let's discuss the theoretical aspects or the conceptual things related to internal reconstruction. If time permits for me, I'll try to start a problem also. I don't think so, but definitely from tomorrow onwards, we are going to start problems on internal reconstruction as well. So for today, if we can able to complete the theory. So meanwhile, practice the other problems under amalgamation, examinations or RTPs or MTPs, whatever the case may be. Still, if you are facing any doubt, at any time you can ask me. Please all of you assemble by 8:15. Let's freshly start the internal reconstruction chapter. Yeah, welcome back, guys. Mm, 1 second. Right. So the next chapter is internal reconstruction. So conceptual wise, or else introductory wise, I gave one point at the time of discussion of the concept of reconstruction, if you really remember at my first class itself. So the difference between external reconstruction and internal reconstruction is, in case of external reconstruction, the existing company is going to liquidate and it will be taken over by another new company. But in case of the internal reconstruction, the same company is going to continue its operations through some internal restructuring. But the basic objective is the same. I mean, whether you can go for external reconstruction or internal reconstruction, what is the basic objective, guys? To show the financial statements at their true and fair view position. So I told you in a particular balance sheet, what happened? There are some assets which may show their valuation at higher valuations while compared with their market values or while compared with their real worth. Maybe sometimes, most of the times, how it will be look like intangible assets. Intangible assets. So maybe it have the goodwill, but it doesn't have any goodwill really. Maybe it have some patents or trademarks only for book purpose. In the outside market, it doesn't have any value. Maybe huge accumulated losses it have. The reason itself is for the undervaluation of assets is this point, accumulation of losses since past few years. So this is purely a sick company. Then the company wants to show the financial statements in true and fair view manner. For that purpose, company adopted the internal reconstruction procedure. So that means in such internal reconstruction procedure, what in generally going to happen, sir? Revaluation of assets may happen and reassessment of liabilities also occur. That is, revaluation of assets and reassessment of liabilities may occur. Majorly, what I can call compromise or arrangement agreements, or rather than giving this much of technical word, we can may have the compounding activities with various parties. So compounding activities with various parties means maybe whatever the liability holders exist, maybe the bank loan, maybe the creditors, or maybe you can also call as shareholders, or maybe with the shareholders. We may negotiate certain terms. Negotiation means, so our company is a sick company. If we are not allowing our credits, the situation will lead to a liquidation of company. At the time of liquidation, we are going to sell. That means liquidator is going to sell all the assets. With the realizations, he will going to settle in a particular order. Then all the liability holders may not get their payments till their markup value or till their book value. If the equity shareholders position is in pretty much worst manner, the reason is at the end, they may get the money from the liquidator. The company is a loss making company, and if I sold all the assets, then the realization will not be sufficient to repay the liability holders as well as shareholders. That's why the company should need to negotiate certain terms with the liability holders and shareholders. How the negotiations in generally will be. For example, a bank loan is there for 5 lakhs. As a full and final settlement, just they are negotiated with a 2 lakhs. They are going to settle right now itself as a full and final settlement. Do you understand? Or maybe shareholder is there. Sir, shareholder face value is 10 rupees. Shareholder should need to sacrifice to the extent of 2 rupees right now itself. They should need to sacrifice 2 rupees means their paid up value is going to convert into the 8 rupees. Sir, now all these factors, company is attaining some profits, right? After making all these negotiations, company is attaining such profits. With that profit, what company will do? The company is going to set off the profits derived from reconstruction process with the huge accumulated losses. That's the main reason for doing all these reconstruction procedure, revaluation of assets and reassessment of liabilities or compounding activities. That's the base objective. So do you mean that what you are trying to telling here? Due to this internal reconstruction procedure, whatever the profit I am attaining, that profit is ultimately going to utilize to set off this accumulated losses. Just I want to make it clean up the balance sheet to show the financial components at true and fair view. That is the base objective of the internal reconstruction. So the entire procedure, just I told you in very layman approach. Is it fine, guys? Now the base objective, do you people understand? I not yet started anything. Okay, just the basic objective just I told here. Is it clear to all of you? Fine. Now let me discuss about the technicalities. Let me start discussing with this PDF. Sir, here there is a company called Rani Limited. So the same example just I'm continuing if you are observing since my inception. So intangible assets it's have, P&L account debit balance it's have. Now during the process of internal reconstruction, I may go with revaluation of assets. I may go with reassessment of liabilities. And as I told you, sacrifice made by the shareholders due to which there may be a reduction in paid up value. I will make a compounding activities with various liability holders like creditors or debentures or bank loan, whatever the case may be. Through all these factors, I am attaining the profits. Whatever the profits I attained, such profits I will ultimately utilize to make it set off the P&L account debit balance. That is the base objective, what I explained till now. The same thing here I worked out. Now, coming here, what is the legal procedure to be followed by each and every company for adopting the internal reconstruction procedure? First, each and every company, before adopting the internal reconstruction procedure, it should need to formulate a scheme. What is the meaning of scheme, sir? The scheme is internal reconstruction scheme. After making so many negotiations or after conducting so many meetings with the various stakeholders of the company, like equity shareholders, preference shareholders, liability holders, each and every terms and conditions will be designed by the company. So once everyone is agreed, the scheme will be sending to the NCLT for approval, National Company Law Tribunal. No one company in India can adopt the internal reconstruction procedure on their own hands without taking approval from the courts. Because so many parties of the company is going to impact due to this internal reconstruction procedure. Do you understand? So that's why whatever the scheme they are going to adopt, such schemes should ultimately need to be approved by the approved court. So in case of companies, you know, various regulators are there. Okay, just you can ignore this. This is for the understanding I told you. So the company related matters is ultimately dealt by NCLT, National Company Law Tribunal. So each and every company, before adopting this internal reconstruction procedure, they should need to take the approval from the NCLT. That means what company will do? Company will send the scheme. So the required forms they will file. The required fee also they will pay. They will clearly communicate all the terms and conditions of the scheme and how the stakeholders are going to impact also they will clearly intimate. Then after checking each and every provision, if it is justifiable manner to all the parties, rather than going for liquidation, it is better to conduct the internal reconstruction procedure if it feels. then LCLT may approve such internal reconstruction. It may pass an order for approval. Then after approval, the company is going to start the real internal reconstruction procedure. Real internal reconstruction means it will revalue as per the valuer comments. Maybe whatever the negotiations or compounding activities it made with the various parties, it is going to implement. After completion of all such things, the company is going to present their financial statements by adding the word and reduced. Why? Because it will clearly represents whenever a person or whenever a party want to conduct a business or want to interact with the company, they can simply understand that yes, the company was previously impacted, the company was previously affected due to the internal reconstruction. After internal reconstruction, this is the procedure. These are the financial statements. They can simply understand by adding the word and reduced. This is what in generally happened as a legal procedure as per Companies Act 2013. So that means what I want to try to tell here, internal reconstruction procedure is a procedure not happen as a single day. It may be continuing for number of years, because accepting the people or accepting the terms and conditions by the people is not that much of easy task. No one will accept. For example, the company should need to pay 10 rupees, but right now they are telling that we can able to pay 8 rupees. Are you ready to sacrifice to that extent of 2 rupees? No. So like to end the result of that negotiation, it will take some time. And ultimately it should need to be approved by the approving authority as well. And then we'll start the procedure. So for implementation of procedure also, it will take some time. Once the procedure got completed, then you should need to prepare the financials again by adding the word and reduced. And one more thing, the NCLT itself clearly provide in their approval letter how many number of years it should need to add the same word and reduced. No need to add forever. So maybe after 5 years you should need to add the word and reduced. So something like that NCLT may tell. So this is the legal procedure we should need to follow before and after internal reconstruction procedure. Okay. Sir, then what are the various methods of internal reconstruction is possible, sir? What are the various methods we have, sir? Yeah. So I'll tell you the methods of internal reconstruction with the help of my OneNote. Okay. So let me take here. So right now I'm entering into the technicalities. Please all of you concentrate. What are the various methods or what are the various possibilities in which we can go for internal reconstruction? So which are methods of internal reconstruction? Alteration of share capital is one method. Variation in shareholders' rights is another method. Reduction of share capital. Reduction of share capital. Compromise and arrangement is another method. Surrender of shares is the other method. Sir, what are all these things, sir? As I already told you, internal reconstruction procedure may adopt by following any of the methods, or by combination of more than one method also you can work out. That is all depending upon the feasibility, or it is all depending upon the components they have. Do you understand? Maybe sometimes the companies may have the good negotiability with the creditors. They may not have the good negotiability with the banker. Do you understand? So something like that, that is based upon their factors, their terms and their condition, their situation. They may adopt any method, and definitely combination of one method also they are going to adopt in their scheme. So such all possibilities we are going to discuss right now. Sir, in case of alteration of share capital, what is going to happen, sir? In case of alteration of share capital, there may be consolidation or subdivision of shares is going to happen. Consolidation or subdivision of shares. In case of alteration of share capital, conversion of shares into stock and vice versa. That means stock into shares may also going to happen. And increase in authorized share capital is also, we can treat it as alteration of share capital only. So simply, when we are term it as a alteration of share capital, alteration of share capital means not like issue of fresh shares. Alteration of share capital means not there is a reduction of share capital. There is another word, the reduction of share capital. How it is different from alteration, I will tell you. Alteration means, first of all, you should need to understand one thing. There is no change in paid up value. Alteration of share capital means there is no change in paid up value. But there is change in some other factors. Consolidation or subdivision. What is the meaning of consolidation? For example, let us assume my company is having 1 lakh equity shares at the rate of 10 each. So total will be 10 lakhs. Now I'm going to convert I'm going to consolidate 10 equity shares into 1 equity share. So 10 equity shares into 1 equity share means how many number of equity shares I will get? 1 lakh divided by 10. Tell me guys, which is equal to 10,000 equity shares at the rate of 100 each right now. Again, the total paid up value will be 10 lakhs. It doesn't intact. There is no change. The only change is face value per share. So earlier it is 10 rupees. Right now it is 100 rupees. There is a change in number of shares. Earlier it is 1 lakh. Right now it is 10,000 equity shares. Sir, why in case of internal reconstruction, consolidation or subdivision is going to happen, due to which no profit or loss is derived by the company, right? Guys, you should need to remember one thing. In case of internal reconstruction, there may be a chance of issuing shares to the various parties at the time of settlement. Or maybe company want to make restructure the existing capital also. So maybe due to any reason, the background thought may be different. Just if they want to make it adoption of such consolidation or subdivision, you should need to follow the procedure. Then at this case, what is the accounting treatment I should need to adopt, sir? Because here you are not the decision maker. Whatever the decision they taken by the management, you should need to provide the accounting treatment. That is your job. Sir, there is no change in paid up equity share capital. That's why you should need to cancel the old equity share capital. In bracket, old face value 10, amount will be 10 lakhs. 2, you should need to credit the new equity share capital. In bracket, new face value 100, again amount is 10 lakhs. You may simply provide the narration being 1 lakh equity shares are converted into 10,000 equity shares by making consolidation of 10 equity share into 1 equity share. That's it. There is no change. There is no impact in the balance sheet. The only impact is change in face value, change in number of shares. Do you understand? Next, similarly, if you're coming to conversion of shares into stock or stock into the share, do you know the difference between share and stock first? So the conceptual difference between share and stock is shares are denominated in particular count. Maybe 10 rupees face value share, 5 rupees face value share, 100 rupees face value share, something like that. Stock may not be denominated in any particular account. Any worth of stock is possible. Yes, 1,05,000 stock is possible. 32,500 stock is possible. And a share is not a negotiable instrument. A stock may be a negotiable instrument. For example, right now all the shares are in digitalized format. No issue at all. On the share certificate itself, it is clearly mentioned the owner of that particular share. But the stock, if the stock is available, is in my hands, then I am the owner. If the stock is available in another hands, he is the owner. And one more thing you should need to remember, while converting shares into the stock, first of all the existing shares should need to be fully paid up. Partly paid up shares cannot be converted into the stock. If the shares are fully paid up, then only you can convert into the stock. Maybe the reason for conversion of shares into the stock is at the time of internal reconstruction, there may be a chance of paying n number of settlements. There may be a chance of issuing n number of shares to the different parties. At that point of time, there may be problem facing with the fraction of shares and all other issue. So to clear that, the organization may want to go for conversion of shares into the stock. Or maybe if the organization want to decrease the number of shares, for certain shares, they may go to convert into the stock. There is no change in total paid up capital, but the circulation of the shares may change in the market. Something like that due to any reason. Again, I'm telling you, due to which company definitely will not get any profit. Just this is again internal structural change. Issue in authorized share capital. If company want to go to issue the further capital in further paid up capital in future, then definitely first it should need to increase their authorized share capital. If you remember, in memorandum of association, there is one clause with respect to the capital, which is capital clause. There also it is clearly given that if you want to change the memorandum of association, which is known as alteration of memorandum of association, the company should need to follow some procedure. The company should pass the what it can call resolution, ordinary resolution. Maybe it is approved by someone. Ultimately, you should need to submit to the ROC. Some procedure will be there in the Companies Act 2013, which is coming under alteration of memorandum of association only, which is coming under alteration of capital clause only. The same thing, alteration of share capital. The same legal procedure the company should need to follow at the time of alteration of share capital. But in case of increase in authorized share capital, no need to pass any entry. But in the balance sheet, you should need to clearly show under notes to accounts the authorized, the change, the rectified or the updated authorized share capital. That is the only one thing you should need to do. No need to provide any journal entries in the books of accounts. That is all related to alteration of share capital, guys. So whenever you want to do the alteration of share capital, articles of association along with ordinary resolution in the general meeting, you should need to clearly present. Articles of association means there should be a provision in the articles of association that you are eligible to do that you are eligible to do that alteration of share capital. Then only the company is eligible, and an ordinary resolution should need to be passed in the general meeting. So increase in authorized share capital is a classic example for alteration of share capital. Subdivision or consolidation or vice versa, both are example for alteration of share capital. Conversion of shares into stock or the stock into the share is also an example for alteration of share capital. One more thing just I forgot to add. In case of conversion of shares into stock, what is the journal entry I should need to adopt, sir? It's very simple. The share capital you should need to debit equity share capital account to equity stock account. That's it. Sir, where I should need to show this stock in the balance sheet, sir? This stock also should need to show under shareholders fund only, but we should not include under share capital. So separately, just we should need to include with the name of the stock. Do you understand? It is also form part of shareholder fund only. So nothing much discussion related to, no need to discuss in deeper manner things related to alteration of share capital. At the time of conducting problems also, very less times the involvement will be there. Okay. Next, let me explain things related to variation in shareholders' right. Sir, what is the meaning of variation in shareholders' right? Sir, the shareholders' right may vary in two forms. In one form, maybe there is a variation in dividend. There may be a variation in what I can call voting. Just for example, your convenience, sir, if cumulative preference shares are converted into non-cumulative preference shares, which is coming to variation. That's right only. Sir, 10% preference shares, if I'm converting into 5% preference shares, it is coming to variation of shareholders right with respect to dividend only. Maybe class A equity shares, I'm going to convert into class B equity shares, which is going to voting right only. So something like that, if you are going to change the right of the existing shareholders due to this internal reconstruction procedure, that particular concept we can term it as a variation in shareholders, right? Sir, due to which company is really getting any benefit now? Maybe company may not get any benefit right now itself. Company may get the benefit due to this in future, because the burden of the company is going to decrease from 10% to 5%. Do you understand? If the company want to dilute shareholders right for any particular class, now this is the choice it have. Sir, now at the time of variation in shareholders right, what is the accounting procedure I should need to adopt? It's very simple. The right which is losing by the existing shareholder, you should need to debit. The new right which they are getting, you should need to credit. For example, for this case, 10% preference share converted into 5% preference shares. You can debit 10% preference share capital, you can credit 5% preference share capital. That's it. There is no change in paid up capital, just there is change in rights. And that is all about variation in shareholders' rights, guys. So if you check the same examples just I provided, okay, this is all about variation in shareholders, right? No need to discuss much about this component as well, okay? Now, let me discuss about reduction of share capital in deeper manner, because so many times we are coming across the reduction of share capital concept under our problems. Reduction of share capital. Okay, so all of you with me? So many students already slept. Okay, one of our students just asking, sir, waiving of calls. I mean, waiving of calls in arrears is alteration of share capital, sir? No. As I already told you, in case of alteration of share capital, the existing capital should not be intact. The amount of capital is same. So some other factors change is there. So that's why it is not form part of alteration of share capital. So just allow me some time. Everything will be covered. Okay. Your points will also be covered through other methods of internal reconstruction. So reduction of share capital may happen in three forms in generally. So in one form is reduction of, no, not reduction, sorry, conversion of partly paid up shares. Conversion of partly paid up shares into fully paid up shares. Conversion of partly paid up shares into fully paid up shares. But how it is reduction of share capital, sir? I'll tell you. I'll give you an example for your understanding. Let us assume a company is having 1 lakh equity shares at the rate of 10 rupees face value. 8 rupees was paid up. 10 rupees is the face value. So this is the scenario. Now what the company is going to do? Company will not call any 2 rupees in future. They are just to try to convert the partly paid up shares into fully paid up shares. Now what the situation is, 1 lakh equity shares they are converting into 8 rupees. Now the face value is also 8 rupees only. Do you understand this? For this, what is the journal entry I should need to adopt, or what is the journal entry I should need to pass? Sir, earlier equity share capital, how much? Face value 10 rupees, 1 lakh into 8, which is 8 lakhs. Which is 8 lakhs. Now I will credit the equity share capital, but right now the face value is 8 rupees. There is no change in amount, which is 8 lakhs. You may presume that, sir, there is no change in paid up share capital. Now, then why it is not the alteration of share capital? Why you are termed it as a reduction of share capital? So alteration of share capital is different from reduction of share capital. Here, the company is losing the opportunity to make a further call of 2 rupees in the future. Or else, in the shareholders' point of view, they no need to pay further any amount. So that part is clearly we can term it as a reduction of share capital only. So that means if it doesn't happen, in future there may be a chance of increase in the share capital. But due to this decision, in future there is no scope to increase of the share capital. Do you understand? Sir, losing of the future opportunity by the company is we can make it term it as a reduction of share capital only. That is the point what I want to convey. But sir, is it really company is getting any profit or loss due to this particular decision? No, in fact, right now company is not having any profit or loss. So company is in fact losing the opportunity of the reduction. So company is losing the opportunity of making call from the particular people. Do you understand? Fine. Why reduction of share capital? It is termed the future increase of the share capital was ultimately lost by the company. So that's why we can term it as a reduction of share capital. Next, still two more things are there. You will convince definitely why it is termed as reduction of share capital at the end. Please let me allow to add some other methods also. Conversion of no, not conversion. Yeah. Reduction of share capital through payment for part of the paid up value. What is this, sir? Reduction of share capital through payment for part of the paid up value. For example, right now 1 lakh equity shares are there at the rate of 10 rupees face value, 10 rupees paid up value. Let us assume. Now, out of this 10 rupees paid up, company wants to repay to the extent of 3 rupees. Company want to repay to the extent of 3 rupees. Now, the new equity share capital, 1 lakh equity shares at the rate of 7 rupees each. 7 rupees each. And their face value may be 10 rupees or the face value may be 7 rupees. It is all depending upon the company's decision. If the company want to convert the equity shares at the rate of 7 rupees, they will not call any further. Then it will put the 7 rupees face value. No, for the time being, we are repaying. And later on, if required, we may call the company is going to continue the 10 rupees face value. But the concept is reduction in the paid up value or the reduction of share capital through making payment for the part of the paid up value. Sir, at this moment, what is the journal entry? Let us assume not the 10 rupees, just the company want to continue their face value with 7 rupees. Then what is the journal entry here I should need to pass, sir? First, you should need to cancel the existing share capital. Existing share capital with face value, how much it is? 10 lakhs. 1 lakh into 10, 10 lakhs, sorry, face value 10 rupees. Amount is 10 lakhs to equity share capital. New how much? New how much? 7 rupees, right? Actually, no need to do all such things. Just give me a second, 1 second. Two possibilities. Let me put 10 rupees face value, 7 rupees face value. Let me write the journal entries for 7 rupees face value first. Later on, I will provide the entry for 10 rupees face value as well. Let me add both for your understanding. If it is the 7 rupees face value, it will pass the entry like that. Equity share capital. So old 10 rupees amount is 10 lakhs to bank. 3 rupees repayment means 3 into 1 lakh, which is equal to 3 lakhs. And a new equity share capital will be 7 rupees face value, which is 7 lakhs. Is it okay, guys? All of you. If the company want to continue the face value as a 10 rupees, but it repaid 3 rupees as of now, still it is also treated as a reduction of share capital only without change in the face value. At that moment, the entry is equity share capital to bank. 3 lakhs. No need to do any other thing. Why, sir? No, there is no change in the face value. Earlier, the face value is 10 rupees. Right now is also 10 rupees. The only change is company is going to repay the part of the paid up value. That's why I decreased that part and I paid in the form of bank. But if there is a change in paid up value as well as face value, then you should need to cancel the old face value. You should need to raise the new face value. Hope you understand this difference, all of you. Okay. So next, let me come to the third reduction. Reduction of share capital through sacrifice made by shareholders. Through sacrifice made by shareholders. What about this? Let me give example. Sir, 1 lakh equity shares are there at the rate of 10 rupees paid up value and the face value is also 10 rupees only. But right now, what the shareholders telling? Sir, we are ready to reduce to that extent of 4 rupees. Not ready to reduce. We are ready to sacrifice. We will forego that amount. No need to pay. We are ready to sacrifice to the extent of 4 rupees. Again, the company will ask how we are going to sacrifice. How we are going to sacrifice means there is only reduction or there is a reduction in face value and paid up value. There is a reduction in paid up value only, but not in face value. How you are going to reduce? They will ask. Like that, how the two scenarios I told you, that same two scenarios are going to apply here as well. Sir, there is a reduction in face value as well as paid up value, sir. Then the entry first I will tell you, consider all of you. The old equity share capital you can cancel. 1 lakh into 10 rupees, which is 10 lakhs. What is the new equity share capital? 2 equity share capital. New equity share capital reduction in face value as well as paid up value. So that's why new face value is 7 rupees, which is 7 or 4. 4 means here 6 rupees, sorry. 6 means amount is 6 lakhs. Sir, now what is the difference? 4 rupees per share is really sacrificed by the shareholders, right? Whatever the profit or loss deriving through internal reconstruction process, we will make it transfer to one single account. That single account we can make it term it as either reconstruction account or capital reduction account, as the case may be. Reconstruction account or capital reduction account. Sir, for some entries you may not write capital reduction and for some other entries you may not write reconstruction. If you want to follow the uniformity, either you can follow the reconstruction, either you can follow the capital reduction account. Now, this is the real profit situation to the company. Whenever there is a real sacrifice exist, then the real profit situation will be exist. So real profit is how much? That is 4 rupees per share, 1 lakh into 4, which is related to 4 lakhs. Now there is a reduction in face value as well as paid up value. Sir, second scenario, how you are going to record the entry, sir? There is a reduction in paid up value, but there is no reduction in face value. Then you should need to write like this: equity share capital to reconstruction. That's it, 4 lakhs. No need to touch the, no need to cancel the old equity share capital. No need to issue the new equity shares. The only thing is the same face value is going to continue in the future as well. Only there is change in the paid up value. Only there is reduction in the paid up value. Do you understand, all of you guys? So ultimately what I want to conclude, I will tell you. In the problem, whenever they are talking about reduction in the share capital and nothing they provided, always we can presume that there is reduction in face value as well as paid up value. But it is clearly given in the problem that there is a reduction in only paid up value, but not in face value. Then only we will adopt the second procedure. If nothing is given means there is a reduction in face value means automatically we can presume that there is a reduction in paid up value also. Sorry, again I'm repeating. Whenever they are talking about reduction in paid up value, if nothing is given, we can presume that there is a reduction in face value as well. But if it is specifically mentioned that, sir, only there is a reduction in paid up value, but not in face value, then only you should need to adopt the second procedure. And whether there is any really sacrifice made by the shareholders or not, you should need to check. If sacrifice is there, then you should need to credit the reconstruction. If there is no sacrifice, no reconstruction involvement will be there. If you check in the first and second scenario, there is a clear-cut reduction of share capital, but there is no sacrifice. That's why reconstruction account involvement is not there. But in case of the last case, there is a clear sacrifice made by the shareholders. That's why involvement of reconstruction account is exist. Is it clear, guys, all of you? Are you having any doubt? Is it fine? Shall I continue? So right, please consider it, guys. This is another method, compromise or arrangement. Sir, what is the difference between compromise and arrangement? I'm not going with the technicalities. In CA final, you might have learned under the corporate laws how the compromise is different from arrangement. So there are various practical cases also you may come across in your corporate laws. I'm not dealing with all such situations. So in very basic manner, just I want to try to put here. The difference between compromise and arrangement is, compromise means first a dispute is going to arise in between the parties. In between the parties means one party is company and the other party may be anyone, that is maybe the shareholder or maybe a creditor or maybe a bank loan person or maybe a debenture, anyone. First there may be a dispute. Dispute means both the persons may not agree for similar terms and conditions. So the company just telling that, okay, you should need to sacrifice 40%. And the other party is telling that, no, I'm not ready. I will only sacrifice to the extent of 10%. Then after making so many negotiations, if the parties will compromise to each other, then that particular agreement we can known as compromise. So compromise is an agreement entered between company and the other stakeholder after making the final negotiations. In case of arrangement also, negotiations will be there, but there is no dispute. So once the terms and conditions discussed among the parties, then both the parties agreed for such terms and conditions, then we can simply term it as arrangement. Sir, but definitely when a particular agreement is known as compromise or arrangement, in that particular agreement, if sacrifice is there, then only it should be known as compromise or arrangement. Or I cannot put it as sacrifice, but definitely there is some change. But definitely if there is some structural change in the financials exist due to that particular agreement, then only that particular agreement we can call it as compromise and arrangement. Not due to each and every condition we may not agree an agreement in between company and the other stakeholders. So as per that particular compromise or arrangement agreement, we should need to provide the accounting treatment. I'll give you various examples here because compromise and arrangement agreements are not rigid, those are flexible. So in any manner, any way, the company and the other stakeholder can enter into the agreements, but based upon the information given in the problem that you can treat it as agreement, accordingly you should need to provide the accounting treatment. I'll tell you, let me take the first example for your understanding. So an agreement entered between company and debenture holders. So right now, 10% debentures held by the debenture holders in the company at the rate of 10 lakhs. Now what the negotiation is, Out of this 10 lakhs, to the extent of 5 lakhs, company is going to pay in the form of cash right now itself. For the remaining 5 lakhs, debenture holder should need to sacrifice. This is the arrangement, or this is the final negotiation, or this is the agreement occurred in between company and debenture holders. Now I should need to provide the accounting treatment for this agreement. First, I should need to cancel the entire debentures, no doubt about it. 10% debentures accounted are. Amount how much? 10 lakhs. I'm going to pay in the form of cash for 5 lakhs. Remaining 5 lakhs, if those are sacrificed by the debenture holders, then I should need to make it credit to reconstruction account. So this is the entry. So simply this entry is all depending upon the agreement terms and conditions. That's it. So let me give another example. This is example number 2. So 10% debentures right now, 10 lakhs. Let me continue the same. But how right now the agreement will be? Company for the remaining 50%, or for the first 50%, company is going to convert debentures into equity shares, and out of the remaining 50%, company is going to pay cash. Okay, I'll add one by one. Please, all of you observe. There will be some changes, example to example. And the rate of interest of 10% debentures in future will not be payable, will not be paid. You know, once the debentures are going to convert into equity shares, why they will pay? They will not pay. These are the terms and conditions entered in between company and the debenture holders. Now, what is the journal entry I should need to pass? Anywhere any sacrifice is there? No, nowhere no sacrifice. So first 10% is debenture holders account that are 10 lakhs, to cash 5 lakhs, to equity share capital 5 lakhs. Please concentrate. The same example just I'm going to extend. What is the example is all about? Which is example number 3rd. Again 10% debentures are there, 10 lakhs. Now for the 50% is 5 lakhs. Debenture holders are ready to sacrifice, provided if the company is going to issue 1.5 lakh worth of equity shares. For the remaining 50%, company straight away paying in the form of cash. Example to example, I told you difference will be there. Sir, now here, out of this 10 lakhs, to the extent of 50%, debenture holders ready to sacrifice. Provided, I clearly told, if you check here, I clearly told provided if the company is going to issue 1.5 lakh worth of equity shares to the debenture holders. Now tell me, gross sacrifice made by the debenture holders is 5 lakhs. Okay. But in return, what they are expecting? In return, they are expecting 1.5 lakh worth of equity shares. That's why the net sacrifice made by the debenture holders is 5 lakhs minus 1.5 lakh, only 3.5 lakh only. That's why how much amount I should need to make it transfer to reconstructions are not the gross sacrifice. Net sacrifice I should need to make it transfer to reconstruction account. So then what will be the journal entry, sir? 10% debentures account that are 10 lakhs, you should need to cancel. The net sacrifice amount is 3.5 lakh. That is to reconstruction account 3.5 lakh. For the 1.5 lakh, they are issuing the equity share capital. That is equity shares. That is equity share capital. And the other 50% they are repaying in the form of cash, 5 lakhs. This is the entry you should need to make. So what I want to highlight here, whenever there is a sacrifice made by the party, is it net sacrifice or gross sacrifice? You should need to check. If in return they are expecting anything, then you should need to provide the reconstruction account with net sacrifice amount. In return, if they are not expecting anything, then gross sacrifice is equal to net sacrifice. With that amount, you can directly make it transfer to the reconstruction account. Is it okay to all of you guys? So just I'm talking since last 1 hour like anything. Just let me know, guys. Where is the reconstruction account shown in the balance sheet? Wait, yeah, wait till the completion of internal reconstruction. Why you are that much of in hurry mode? Okay, just wait till the completion. I'm not yet done now, so I'm telling one by one. Okay, everything I'll cover. No worries. Okay, this is all about compromise and arrangement. Still, lot more issues I need to discuss in case of compromise and arrangement. Let me add one more point in case of compromise and arrangement. Okay, just for your understanding, which is last example you can consider. Example number 3. Yeah, up to 3 I done, right? Let me take the fourth example for compromise and arrangement. So let us assume bank loan is there for 5 lakhs. In my organization, one freehold property is there, which is at the rate of 3 lakhs. Now, during the process of internal reconstruction, the freehold property is revalued at the rate of 3.5 lakh, and the revalued freehold property is going to be settled to bank loan party as a full and final settlement. Provided banker is expecting to receive 50,000 worth of equity shares. This is the agreement. One more time I'm telling you, just I complicated all the situations. Please concentrate. Bank loan is there for 5 lakhs. There is an asset called freehold property, which is to the extent of 3 lakhs. Now that freehold property is revalued at the rate of 3.5 lakhs, and the same freehold property is just given to banker as a full and final settlement. But in return, banker is expecting 50,000 worth of equity shares. Then all of you, let me post your answers. Let me check first. Your entry. Just I required your entry. So please take like 1 minute time and clearly think and give the journal entry. I already told you the logics, how you should need to think. Just you can give your answers. I'll wait for a minute. So anyone gave any entry here? So bank loan 5 lakhs to freehold property 3.5 lakh. So the amounts you should need to provide, right? First, what you should need to do, I'll tell you. Sir, first there is a revaluation of at the extent of 3.5 lakh means here itself 50,000 profit is there. At 50,000 profit, you should need to transfer to reconstruction. Yes, this is a profit under reconstruction. That's why the first and foremost entry is freehold property account data. You should need to increase the asset to the extent of 50,000 to reconstruction account 50,000, which is nothing but revaluation of freehold property. So I'll give the a flow chart for revaluation of assets and liabilities. What entries you should need to put, but hopefully you might have seen that under AS10 PPE or any other where as well. The same entries there. Revaluation account you may credit here. Just reconstruction account you may credit. There is no difference. So freehold property account data to reconstruction account is the entry. Then the same freehold property you are providing to the bank loan. Just you are assigning to the banker. Now, banker, how much will be the gross sacrifice? How much amount is the gross sacrifice made by the banker? That is 5 lakhs minus 3.5 lakh. That is 1.5 lakh is gross sacrifice. But in return, what is expecting? Equity shares is expecting to the extent of 50,000. That's when net sacrifice made by the banker, how much? Only 1 lakh. Then what is the entry here? Bank loan account debtor 5 lakhs to freehold property 3.5 lakh to equity share capital 0.5 lakh to reconstruction how much? 1 lakh. So total 2 entries you should need to pass. This is the one entry, this is the other entry. Sir, I don't want to pass 2 entries, sir. I want to pass one entry, sir. You can pass the net entry also. Here you increase the freehold property 50,000. Here it decreased the 3.5 lakh, right? So here reconstruction is 50,000. Here reconstruction is 1 lakh. Rather than passing 2 entries, you can pass one single entry as well if you want. But I'm always suggesting to pass 2 entries. Otherwise, you might have confused. So that is bank loan account debtor 5 lakh to freehold property 3 lakhs to equity share capital 0.5 lakh. Remaining amount to reconstruction 1.5 lakh. If you check these 2 entries, the net impact will be the same entry. It's a little bit confusing, right? But if you're checking like this way, the picture will be clear. Is it fine? Anyone having any doubt in this? Hope you understand this. Okay. Fine. Apart from this, guys, one more type of reconstruction is also possible, which is surrender of shares. I'm not discussing this concept surrender of shares at this time. So after completion of some problems based on the existing methods, let's check the surrender of share concepts at the end of this chapter. Then we'll try to do the problem based on the surrender of shares. That will be a good idea. Okay. Now, without any further delay, sir, after this, what we will do, I'll explain. Sir, after completion of all this internal reconstruction, what we are going to do? Or I think so, some more special aspect also I should need to discuss. Okay. Let me continue the still methods only. Methods under methods only. Compromise and arrangement only. Let me continue. Let me give one other concept. What is that? I'll tell you. Concept is unrecorded asset and liability. unrecorded asset and liability. So what is this unrecorded asset and liability concept, sir? I'll tell you. Sir, maybe a particular liability was not recorded in the books of accounts. Maybe maybe ignorance due to management, or maybe error committed by the management. Anything was happened, but during the internal reconstruction, that liability was identified. Let us assume the liability is amount payable to a particular supplier. So that was around 1 lakh. That was around 1 lakh, which is a liability. First of all, let me know, if you want to record that particular liability, what is the entry in general you may adopt? The entry is to record any liability. P&L debit to liability credit. So right now, you should need to increase the credit aspect. You should need to increase the debit aspect. There is a loss due to this. But we are in the process of internal reconstruction. Any profit or loss should need to happen through reconstruction only. So reconstruction account debtor 1 lakh to liability 1 lakh. Now the point is, are you discharging the entire liability? That means, are you paying the entire liability? Yes, sir. I am paying the entire liability. Then the entry is liability to bank. Now liability credit, liability debit, that's why the net entry is reconstruction to bank account. No, sir. I'm not discharging the liability. The liability holder sacrificed their entire portion. We are in the process of reconstruction. The liability holder is going to sacrifice the entire amount. Then for recording the liability, same entry, reconstruction to liability, that is 1 lakh. If the liability holder entirely sacrificed, then the entry, liability to reconstruction. Tell me guys, to the extent of gross sacrifice, I should need to credit the reconstruction account. 1 lakh, 1 lakh. Reconstruction to liability, liability to reconstruction, cancelling with each other. That means no need to pass any entry. I will add one more scenario. Please concentrate. Discharged the liability, but not at book value, at less than book value. 1 lakh is the liability, right? But as a full and final settlement, I am paying only 40,000. Remaining 60,000 is sacrificed by the other party. Then recording the same entry, reconstruction to liability, first I should need to record 1 lakh, 1 lakh. Then later on, what I should need to do? I should need to debit the liability to the extent of 1 lakh, out of which how much I am paying to bank? 40,000 I am paying. Remaining is sacrificing, means reconstruction 60,000 should need to go to the reconstruction account. Now if you check here, liability credit, liability debit cancel with each other. Reconstruction 1 lakh debit, reconstruction 60,000 credit. To the extent of 60,000 cancel with each other. That's why the net entry is reconstruction 40,000 to bank 40,000. Sir, why you told 3 different scenarios, sir? Whenever an unrecorded liability exists, if the entire amount is sacrificed by the other party, no need to pass any entry. Sir, the other party, we are paying either entire amount or less than the book value. To the extent, how much amount we are paying, we should need to pass one entry, reconstruction to bank. If you are paying the total amount, then reconstruction to bank 1 lakh. If you are paying only part of the amount, remaining amount is sacrificed, then reconstruction to bank. If the entire amount is sacrificed, no entry. And the conclusion is, if sacrifice, no entry. If you are paying something with that particular amount, you should need to pass the entry, reconstruction to bank. Do you agree all of you this? Next, let me come to the asset. Asset, I don't want to make it complicate, because liability portion only we may come across number of times. So at asset portion, it's very easy. Sir, any particular asset is there which was unrecorded. Right now you want to record. First you can record asset to reconstruction. Let us assume which is 1 lakh. Are you going to sell that particular asset during the process of internal reconstruction? Yes, sir. At which value you are going to sell? Let us assume 1 lakh asset I am going to sell at 1.2 lakh. Then the entry is bank account debtor 1.2 lakh. To asset 1 lakh, to reconstruction 0.2 lakh. Tell me guys, now asset 1 lakh debit, asset 1 lakh credit. Here reconstruction 1 lakh credit, reconstruction 0.2 lakh credit. That's why the net entry is bank 1.2 lakh, to reconstruction 1.2 lakh. This is the entry. That means in case of assets also, if any unrecorded liability is there, at which value you are going to sell, for that I will record the entry bank to reconstruction. If the other party is not getting anything, then no need to pass any entry. So the conclusions I will tell you. Concentrate. If at all any unrecorded assets or liabilities exist, if it is sacrificed or nothing we are able to recover from that particular asset, no need to pass any entry. In case of unrecorded liability, if the other party sacrifice some amount, if you are paying something, then reconstruction to bank. If the other party is not sacrificing anything, we are paying the full amount, reconstruction to bank with that full amount. Sir, we are selling that particular asset, we are realizing something. How much amount we are realizing? For that amount, you should need to pass the bank to reconstruction in case of assets. Is it clear? Please tell me, guys. Is it fine? Is it understand? Okay. Now I will tell you why most of the times they are providing adjustments in problems with respect to liability. You know, accumulated dividend on cumulative preference shares. Actually, you know the concept of dividend, right? When the company is having sufficient profits, the company wants, then it may pay dividend. If the company is not having any sufficient profits, then the dividend no need to pay. But in case of cumulative preference shares, the preference shareholders will have a right that whatever the dividend is in arrears, it can able to receive when the attainment of profits by the company or at the time of attainment of profits by the company. That means these all are arrears of dividend on cumulative preference shares. Now, right now, during the process of internal reconstruction, whatever the arrears they have, all we can treat it as a unrecorded liability. Actually, it is not a liability, but during the internal reconstruction process, it is a liability. Because this is where the rights of the shareholders, as per the right of the shareholders, they may ask money from the company. That's why we may treat it as a liability at the time of internal reconstruction. Now you can treat it as an unrecorded liability. In the problem, sir, arrears of cumulative preference dividend is there, but preference shareholders sacrificed, then no need to pass any entry. Sir, arrears of cumulative preference dividend is there, only 1/4 is sacrificed, remaining 3/4 we paid. Then for the 3/4 only, you should need to pass the entry reconstruction to cash. Or if they are expecting equity share, reconstruction to equity share capital. If they are expecting debentures, reconstruction to debentures. So for that reason, I clearly made this flow chart. And let me give this revaluation flow chart also before going further. What is this revaluation? Revaluation of assets may happen. Revaluation of liabilities may happen. In case of revaluation, maybe upward revaluation is possible, downward revaluation is possible. Liabilities also upward revaluation is possible, downward revaluation is possible. In case of upward revaluation of asset, which is profit situation, that's why asset to reconstruction is the entry. In case of downward revaluation, loss is possible. That's why reconstruction to asset. In case of upward revaluation of liability, which is clear-cut a loss situation, that's why reconstruction to liability. In case of downward revaluation of liability, which is profit situation, that's why liability to reconstruction. So the same may also, we may come across number of times while doing the problems. Next, sir, after completion of all these internal reconstruction procedure, what I should need to do? You should need to find how much balance is there under reconstruction account. Should need to find how much balance is there under reconstruction account. Let us assume under reconstruction account, I have 22 lakhs balance, which is profit. Let us assume profit. Now, what is the objective of my internal reconstruction? To set off the P&L losses, right? Whether it is mentioned in the problem or not, out of the profits we are getting through internal reconstruction process, you should need to make it set off the P&L account debit balance. Let us assume I have P&L account debit balance for 15 lakhs. Now you should need to make it set off the reconstruction account with P&L, that is reconstruction account debtor 22 lakhs to P&L. P&L is having debit balance, right? Now, if you set off with the reconstruction account, it may be credited. That is 15 lakhs. Now, the excess of reconstruction over P&L account debit balance, which is a capital profit, you can transfer to capital reserve, which is 7 lakhs. Do you understand all of you this point? No, you may ask another question. Sir, reconstruction account balance is not sufficient to set off the P&L account debit balance. Now, let me make it reverse. This is 15 lakhs, sir. This is 22 lakhs, sir. What you will do at that moment? Now, to the extent of the reconstruction balance, you should need to make it set off the P&L. That means reconstruction account at R 15 lakhs. P&L also you should need to make it set off P&L. Still I have P&L account debit balance, right? The P&L account debit balance still it is showing 7 lakhs. You may set off with other reserves if the company have. Because my objective is want to make it set up this P&L account debit balance. If the company is not having any other reserves, what we can do? Still we are going to continue the P&L account debit balance in the balance sheet with 7 lakhs. The situation is good little bit well compared with past, right? Earlier, I am showing it as 22 lakhs, but right now I am going to continue to show it 7 lakhs. If the company is attaining profits for either 1 or 2 years in the future, then it will also be set off. That is the thing what I should need to do. Okay. Fine, guys. So just orally we discussed everything, the process of internal reconstruction, the methods of internal reconstruction I told, the objective of internal reconstruction I told. At the end, after completion of internal reconstruction, whatever the balance exists under reconstruction, we should need to make it set off with the P&L account balance, irrespective of the fact whether mentioned in the problem or not. The excess of reconstruction balance over P&L account debit balance, you should transfer to capital reserve. You should need to show that capital reserve under reserves and surplus. If the reconstruction account balance is not sufficient to set off the P&L account debit balance, then to that extent only you may set off the remaining balance of P&L account debit balance. You may set off with other reserves. Such other reserves are also not available. You can continue to show such P&L account debit balance in the balance sheet. So further discussion will be there in the next session. Probably in the next session we are going to do we are going to entering into the problems as well. Let's do whatever the problems we can do in that particular session. Let's complete, except on surrender of shares. Surrender of shares concept and the problems I will take at the end. Okay. But one thing is sure, guys, in case of internal reconstruction, the theory or the conceptual content, we will learn very few issues, but while resolving the problems only, we may learn much. Okay. So that's why let's give a good time for resolving the problems in case of internal reconstruction. Until bye, guys. Have a good day.